This is Beyond the Business, Weekly Digest.
Over the past decade, sustainability became one of the most dominant narratives in business. ESG frameworks expanded, capital flowed into green funds, companies adjusted reporting, and the expectation was clear. Sustainability would define the next phase of economic development. But over the past 12 to 18 months, something has started to shift. Not in the headlines, in the numbers. Because if you look closely, the story is no longer about the growth, it is about correction. In 2025, ESG funds experienced approximately $84 billion in outflow. Just a few years earlier, they were attracting tens of billions in inflows annually. At the same time, under stricter European disclosure rules, hundreds of funds were reclassified because they could no longer meet the required sustainability criteria. Some of the largest asset managers reduced exposure to what are known as Article 8 and 9 funds, categories that represent the most sustainability focused end of the market. In Europe, revenues linked to ESG products dropped by more than 30% in some segments. And yet, the broader ESG market did not collapse. It continued to grow. Estimates place it at around $39 trillion with a projection exceeding 45 trillion in the near term. So the question is not whether ESG is declining. The question is why capital is leaving some parts of it while the overall system continues to expand. And the answer comes down to one thing: expectation versus reality. For years, ESG operated under a relatively simple assumption that sustainability would align with the performance, that investing in environmentally responsible assets would not only reduce risk but also generate stable returns. In some cases, that worked, but over the time, the gap between narrative and performance started to grow. Returns became inconsistent. Ratings between ESG agencies often contradicted each other, with the same company receiving very different scores depending on the framework used. And investors began to notice. This is where the correction started. The $84 billion outflow is not just a financial movement, it is a signal that capital is becoming more selective, not leaving sustainability but stepping away from uncertainty. At the same time, scrutiny is no longer theoretical. In both Europe and the United States, regulators have increased pressure on ESG disclosure, and several large institutions have already faced investigations linked to greenwashing concern. In response, asset managers are adjusting quickly, renaming funds, tightening criteria, or removing ESG labels where they introduce legal risk. This is not cosmetic, it is structural, and the shift is already happening from narrative to verification. Despite the outflows, the overall ESG market continues to grow. But the way capital moves inside it has changed. Growth did not disappear, it became more precise. Investors are no longer spreading capital across broad ESG categories. They are concentrating it in areas where impact is directly linked to performance: energy infrastructure, grid expansion, storage, water systems. In Europe, delays in connecting renewable energy projects to the grid have already created bottlenecks, forcing governments and investors to prioritize infrastructure over generation. This turns sustainability into practical constraint rather than a strategic theme. At the same time, private capital is increasingly moving into logistics hubs, ports, and energy assets, where demand is measurable and returns are tied to usage. This is a different type of investment logic, less narrative and more exposure. At the same time, one of the most complex contradictions is becoming visible. The transition itself is creating new environmental pressure. Demand for critical materials continues to grow. Nickel, lithium, cobalt, all essential for electrification and battery production. Global nickel demand alone is expected to increase from around 3.4 million tons today to more than 5 million tons by 2040. But extraction is not neutral. In Indonesia, the rapid expansion of nickel mining has been linked to deforestation and increased emissions from coal powered processing. In Chile, lithium extraction is placing additional pressure on water resources in already fragile ecosystems. These are not side effects, they are part of the transition itself, which creates a difficult reality. The system is moving forward, but it is not becoming simpler. It is not becoming cleaner in linear way. Another shift is happening in how companies interpret sustainability. It is no longer treated as a reporting layer. It is becoming part of operational risk. More than half of large companies now report direct impact from climate related factors, not projections, actual disruption. In 2024, low water levels in the Rhine reduced inland shipping capacity, increasing costs and forcing supply chain adjustments across Central Europe. In Asia, heat waves affected manufacturing output by reducing working hours and productivity. In several regions, extreme weather events disrupted logistics flows and increased insurance exposure. These are not isolated cases, they are signals, and they change how decisions are made. Because once risk becomes immediate, it stops being strategic, it becomes operation. This is where everything becomes measurable. Insurance. Over the past few years, global insured losses from natural disasters have reached between 250 and 300 billion dollars annually. And the trend is moving upward. In California, insurers have limited new policies in wildfire prone areas. In Florida, several companies have exited the market after repeated hurricane losses. In parts of Europe, flood risk is being reassessed, leading to higher premiums and stricter underwriting. But there is another signal that is less visible and equally important. In Australia, insurers have started pricing climate exposures into long term property risk, making certain regions progressively less insurable over the time. This does not create headlines immediately, but it changes behavior because once insurance becomes expensive or unavailable, investment slows down. And when investment slows down, development follows. This is how sustainability moves into the real economy through cost. Once risk is priced, capital adjusts, not based on narrative but based on exposure. This explains why fossil fuel investments remain high. In 2023, global investment in oil and gas exceeded $500 billion. At the same time, renewable investment continues to grow. Both are expanding. Because capital is not choosing between transition and stability, it is positioning across both. In practical terms, this means portfolios include renewable infrastructure alongside traditional energy assets. Not because the strategy isn't clear, but because the environment is. At the same time, tools are evolving. Large institutional investors are now using artificial intelligence to assess ESG risk across portfolios. The Norwegian Sovereign Wealth Fund, managing over $2 trillion, applies AI to screen companies continuously. Analysis that once required weeks is now done within hours. At the same time, satellite data and real time monitoring are being integrated into decision making. This allows risk to be tracked as it develops, not after it happens. And that changes the pace of decisions. So, this is not the end of sustainability. It is the end of how it is used to be understood. The version built on labels and expectations is being replaced by something more grounded, more measurable, and more demanding. Capital is still there, but it's moving differently. It follows risk and not narrative. And once risk becomes visible and priced, decisions begin to shift with it. Not all at once, but steadily. This is where sustainability stops being a story companies tell and becomes a condition they operate with it.